Ray Dalio has always talked about the longer-term debt cycle and the volatility of credit, peaks and valleys of easy and tight lending conditions. How would you describe the credit cycle we are in, and where is the puck going in credit?
Credit's, I mean, if you look actually in the current macro deck, Darius Dale did a nice job with this. This is showing debt service ratios is an important concept to look at. Let's see if you guys can dig this. This is classic Darius work, which is in the depths of the Department of Macro Research at Hedgeye. Slide 97, guys. And this is what really stops, and Dalio knows this, because he calls it a beautiful deleveraging or an ugly one. And an ugly one is when you have too much leverage and the economy is slowing. We understand that. We agree with them 100%. Okay, so if you look at this, what we're oh, geez, I just gender on you. Give me back Darius's point here. Okay, so here we're showing so this is important because, okay, just circle this. This is back in 07, okay? This is 2007, whereas right here we're talking about, here we're talking about the latest, okay? So this is looking at the same thing at two different points in time. This is looking at the change in credit growth versus the change in debt service ratios. So again, how much debt do you have and how fast is it growing? What's the rate of change? That's why we have see this little triangle? That's the rate of change. What is the delta in credit growth and in debt service ratios? How much does it cost you to maintain or service that debt? You could see back in 2007, and this is why we made the big bang call in 2008, or at least one of the big reasons, we had A, growth slowing, but B, we had all the countries, that should be very red, by the way. Apologies in advance for the blue pastel. This should be super red, okay? This one, and that was really bad, okay? Now, not all of these countries have moved up into where the danger zone would be. The danger zone does have USA rising. It's not where it was. Don't forget that the USA went up here. Canada, my homeland, is in a very big problem from a leverage perspective versus debt service ratios. So again, these conditions can be measured and mapped on a daily basis, a weekly basis, a monthly basis. But what you really need to do to nail this stuff is track the biggest causal factors, which indeed are growth slowing at the very top of the list, into these things climbing up into the right of the charts, okay? The combination of growth slowing and debt rising and deficits rising and demographics going the wrong way, we call that 3D risk, debt, demographics, and deficits. That's always been there. What people tend to forget is that the cycle really matters in as much as anything else. So whether it's when it's accelerating, a lot of those issues don't matter to markets, and when it's slowing, growth slowing, they matter a lot.
Yeah, I think too the other point to make is that, I think that when you have debt growth that's growing faster than, I guess, output or income growth, that's obviously an issue. And like usually what would happen is what central bankers will usually do to try to kind of ease that burden, because you don't want that to last for a long period of time because you become over leveraged, is they'll lower interest rates, they'll
Yep.
provide some kind of easing mechanism to allow people to leverage up more, but at least there's this handoff to more income growth, so that income growth is growing faster than debt growth. So I think the point here kind of on this chart is that, an argument people will make is that, there are a lot of levers that central bankers can pull. I think that if you think about that in a long-term cycle, I think Dalio's point that he's made in the last decade or so is, look, you had this series of lower highs in interest rates. You get all the way to zero, so you get to a point where you have this leverage problem and there's not much that central bankers can do about it because they can't ease the debt burden, debt growth by lowering interest rates anymore. So then it's like how that's handled can either be ugly, so what he calls ugly or beautiful in some sense, like trying to de-lever, and even when the central bankers and central banks are kind of running out of tools or ability to do that. Mm-hmm. And so I think that's kind of that's a super long-term debt cycle, and he never claims to be able to, and no one really, no one would ever claim to know the day that's going to happen, like you said with the last question. No one knows when that's going to happen. Who knows? Plays out over multiple years and decades.
His work, and we're not trying to tell you we're Ray Dalio, and he wouldn't tell you he's trying to be us. In fact, I think we do a lot of things that he doesn't do that are new. I'm not trying to say that makes us God's gift to macro, but we've gotten a lot of things right that he hasn't had right, and that's I don't think that that's ironic. It's just that we've applied his process or part of it. Now that I know what his process is, I didn't copy his process. I had my own rate of change process going back 20 years now. I just applied a single stock picker's process to rate of change process to macro. That's what I did, okay? And it just so happens that we are aligned in many different ways in terms of, pardon the pun, the principles of what we do. And rate of change is a big one, and using growth and inflation as the biggest leading indicators or causal factors are indeed two big things too.